Money Show.
Personal Finance with Warren Ingram.
Personal financial advisor, co-founder at Galileo Capital and regular Money Show contributor on personal finance, Warren Ingram, with us on a Thursday night, as usual. I was chatting to somebody the other day and they said to me, I don't want to invest anymore because it feels like I put money away for the future and I feel like I'm losing money all the time. I keep checking in on my investments. It keeps, the markets have been so volatile, fluctuating all over the place. I'm getting really despondent about my investments. Is that common, Warren?
It's absolutely common. I think it's there are actually very few people that kind of get a positive sense from their investments. Even when you track their investments over a number of years, you'll find that if you had to ask them intuitively, they would say it hasn't grown much at all. And when you actually measure it, you might find a very different result where they've had a very good return. And there's some kind of good behavioral science behind this, and then just some kind of just basic understanding of how markets work. And so the behavioral science part is we get let's say kind of a kick of 10, emotional kick of 10 when we make money, but we get a kind of a emotional loss of about 100 when we lose money. So if you had to measure money by unit, then you would say, well, we feel some sort of positive sense when we make money, but losing the same amount of money as we've made, we would actually feel a lot worse. So
what's this called? This is called loss aversion, isn't it? I mean, we over-exaggerate the loss and we under-emphasize the gains.
Yeah, and it's actually just it's kind of hardwired into our lizard brains. We kind of expect to make money. So when we do make the money, it's just what we expected. So why would we get excited? And equally, we don't really expect to lose money. So when we do, that sense of loss kind of stays with us. It burns into our brain. And then, if you're doing that over a period of time, you look at it and you go, yeah, it's just this investing thing. I don't really make much money out of it. And, when you show people numbers and real numbers about how they actually have made money, they're often really surprised. They just don't get it. And I think that's the lizard brain part of us, at play. And interesting, I did see a study years ago with psychologists who looked at really big multi-billionaires who lost a lot of money. So someone who loses kind of $1 billion and ends up with only, and I'm saying it advisedly, yes, but only $100 million, and the loss that they feel is almost on par with losing a very close loved one. They're sitting with $100 million in the bank. You would think they would be very happy people, but the loss they've made is so big and the emotional attachment so large that it's the same as if they'd lost, someone that they actually love more than their money. So yeah, the psychology of this is fascinating, but we also need to understand how the stock market works, because it also explains some of this. And if you had to look at the stock market, and the markets all move in very similar fashions all around the world, but you look at a typical stock market over a typical 100 trading days, and over those 100 days, 55 of those days the stock market will be up, and 45 of those days the stock market will be down. So bearing in mind the lizard brain part I've just told you, the little lecture I've just given you, you're not going to feel that psyched about your 100 days of looking at your portfolio every single day, because you're going to remember the losses much more than you're going to remember the gains. And so the interesting thing about that is we obviously don't look at our portfolios daily when things are going well. We don't look at the portfolios when things are trickling up and we feel things are markets and economies and politics.
Well, there's no need, because it's doing what it's supposed to do. So therefore, you don't need to worry about it. We only look at things when when we're frightened, when we're concerned, and then of course we overemphasize the negatives, right?
Exactly, and then we get a bit more frequent on our monitoring, and some people get to sort of hourly monitoring, which is really catastrophic, and everyone else maybe ends up looking at it a couple of times a week or potentially every day. and just really a really bad idea. I mean, and I just think about myself when the Ukraine invasion happened. I don't track kind of world news unless I really absolutely have to, and I certainly don't look at it, by the minute. But I can remember myself kind of being glued to 2 or 3 different global news channels, just watching this crisis unfold. I mean, I have no ability to impact the crisis, but I'm watching it, because it's a massive issue. And I think the same happens with people with stock markets. So definitely, we shouldn't be doing it. But when you look at the world stock markets again over time, and you say, well, hang on, you may only check into your investments once a year, the journey would be a lot different, because actually what happens is, on a typical year, the stock market is up 75% of the time. So you would feel a lot different looking at your portfolio once a year than you would looking at it very frequently. Bearing in mind, we're only going to look at it when things are going down. That's when we look at it frequently. So it starts to become clear why we tend to think the markets don't reward us much, why we don't get excited, and why we find it depressing. And I just, when you jump out to kind of no one's ever going to look at the investments only once every 10 years. But if you had the fortitude to do that, and Warren Buffett would be one of those people, you would find that 95% of the time you're making money. So kind of, listening to your intro about, people who kind of get depressed about markets, I understand it. I understand the psychology, and I understand, because we start to watch the train wreck live as if we can do something about it by just watching. And unfortunately, what we should probably do is not watch anything and go fishing.
Yeah, easier said than done. I mean, so the statistics then show, if you look at your portfolio every day for 100 days, you'll be up 55 and down 45, but you'll have a disproportionate sense of loss because of the loss aversion theory. If you looked at it once a year, you'd be up 75% of the time. Once every 3 years, 84% of the time. And if you could manage to look only once a decade, you'd be up 95% of the time. The 5% wouldn't matter. It's fabulous, actually, in terms of getting a little bit of perspective, because it is easy to lose track and lose perspective on investments. I got an email earlier from Robert, Warren, saying Robert is grappling with whether to use a rand-denominated feeder offshore unit trust and ETF, so dollars or sterling as a direct offshore investment. He may or may not leave South Africa. His concern is the weakening rand over time, as well as limited investment opportunities in South Africa. Robert says, would I be correct in saying that by keeping my rands in an offshore rand-denominated feeder fund, I gain by rand weakness and growth on underlying investments if the investment grows? Also, if the rand weakens, I don't lose out on the underlying investment is in US dollars and the dollar strengthens. I then get this difference out in strengthening rands. Question. Invest in, and then it goes on a little bit in terms of some numbers and stuff. But just give us a sense of what Robert's conundrum is.
So there are 2 sort of sets of dynamics when you're looking at investing overseas. The first one is, am I buying into an overseas market that's offering good value? So how am I going to get the actual growth of the overseas market? So just to kind of simplify this a little bit, so let's just say you want to invest in the US stock market, and then the question is, if I've got dollars, am I allocating those dollars correctly at the right time to the value of the US market, and do I make some money out of the stock market growing there? So that would be very similar to deciding to invest in the JSE with your rands. But when you're making an investment decision to allocate money overseas, you've got another complete different dynamic which you have to consider, and that is the beloved exchange rate. It's how much the rand is moving against the US dollar, and when the rand, let's say at the moment, is sitting at whatever it is today, 18 rand 10 cents to the dollar, someone like me is saying, gee, I'm not convinced that that's a great price to convert my rands into dollars. I think the rand is probably worth about 16 rand 50 to the dollar. So there is, if you're going to send money out now, just understand that that's kind of a whatever it is, 14-15% loss that you're taking on the exchange rate, because I believe the rand might come back to that level of 16.50.
You're not alone in that belief, Warren. Okay, I want to get to the belief in just a moment. But the thing that troubles me about Robert's question this evening is it is about the propensity of questions that come through at times like this where the rand has blown out. And it has been a phenomenon I've noticed over 20 years of doing this show, of people who, when things go bad, they go, oh, I need to move all my money into dollars, or all my money into pounds. Over time, you get sort of forgiven by gradual devaluation of the rand. But often, we're making our offshoring decisions at precisely the wrong point, because we're doing it based on fear, not because, hey, it's a good idea to do so.
Exactly right. And to me, this kind of movie we're living in right now feels a lot like the movie we all lived through from the year 1999 through to the year 2000, and then all the way up until 2010. But at that time, we had this horrible emerging markets crisis, and it was the end of the Asian tigers, and all emerging markets were, according to kind of Time magazine and everybody else, it was the end of emerging markets and the end of South Africa. And people sent their money out at any exchange rate they could. And what subsequently happened was we had the tech bubble burst in America. The stock market in America did nothing for a decade, and the South African market boomed. And if you look at valuations, I'm certainly not saying that's exactly the story that's going to unfold in the current kind of movie that we're in now, but this looks like a similar kind of movie. And to me, you're looking at two things: the valuation of the stock exchange in South Africa, so the average price of the companies that you're buying on the JSE versus the average price of the companies that you're buying in America, just to stay on the American theme. And South African companies are much cheaper than American companies. So what you're doing now is if you're sending money overseas, you're buying into a market that was cheap a little while ago. It's not so cheap anymore overseas, and you're sending your rands out at a horrific exchange rate. And there's another kind of behavioral thing around this, which is called recency bias. Whatever's happened in the last year or two in our brains, that's what's burnt into our brains, and we believe that's what's going to happen for the next 1,000 years. And the last year or two definitely not been great for emerging markets, definitely not been great for South Africa, and so the rand is weaker. And now we mentally project that that's what's going to happen forever. And of course, that's not what's going to happen forever. Markets move in cycles, and this cycle will turn again. And I know we've got thousands and hundreds of thousands of listeners throwing something at their radio right now, going, "Are you nuts? Do you not know we've got stage 6 load shedding and all the other problems we've got?" I'm fully aware, and my commentary around this is we're in a big cycle where emerging markets as a class of assets are out of favor. And when they come back into favor again, and they will, then we will benefit from that. How much we benefit and how well we perform relative to other emerging markets is anybody's guess. But we will participate in that turning of the cycle, and that's the logic. I'm not factoring in that. I think Eskom's going to be fixed next week, and we're going to have no load shedding ever again. Of course, we're going to have power problems probably until June or August next year. But the cycle turns, and bearing in mind, our stock market is not just the price of South Africa's economy. We've got very big businesses operating all around the world that are really cheap. And selling all of your rands, buying dollars, really bad idea.
But let's say Robert decides he wants to do this anyway because he wants the peace of mind. He's willing to, in the short term, he believes, to take the chance of losing out and seeing the dollar lose value and the rand retrace a little bit. But he's got a long-term view. He wants to put his money into dollars, and he wants to put it into funds. Does he keep it in rand-denominated funds? Does he convert it into dollars? What does he do as of now as a sensible strategy? We discussed lots of theory. What should he do?
If he buys my argument somewhat, in other words, he says, okay, I don't want to just send it all out at one shot. Then what he could do is he could do it via a debit order or let's say monthly lump sums. And if he's going to do that, so he's going to break up that capital into smaller bunches and do them, let's just say, to me, a debit order makes all the sense in the world. Then I think a feeder fund is the right idea because you're not being exposed to the foreign exchange costs of the banks, converting your rands into dollars.
What? So a feeder fund is a locally denominated fund, right? So it's invested in offshore investments, but it's you pay for it in rands and it stays in rands.
Stays in rands. However, if the rand goes from 18 rand 10 at the moment to 25 rand, you will make profit on that 7 rand difference in the exchange rate, plus whatever the international markets have done in terms of their growth. Right. So you're not losing out on the exchange rate falling apart if you do that. So not a bad idea. But if you're going to do a big lump sum and send a large amount of money overseas, then by all means convert your rands to dollars, send it out, and then buy the markets on the other side.
All right. Thank you. I think, hopefully, Robert, you're happy with that answer. And then a question this evening and the person's name has been cut off this page, which upsets me enormously, from Angie. It's from Angie. My fiancé and I will be getting married at the end of this year. Congratulations, Angie. We haven't really discussed money and finances. Oh, dear, Angie. When is the right time to discuss money and our plans? I want to ensure that we're on the same page regarding our finances to avoid any surprises. I fear, Warren, that Angie may have left this conversation just a little bit late.
I was going to be flippant and say, Angie, the right time to ask that question was before you said yes.
On the first date, yes.
Assuming your fiance proposed, then before you said yes, I would have said, can we have a conversation about money? Not how much are you going to pay me, but how does your finances work? How do my finances work? And what do we think about certain things like debt, etc. So it's not too late. You're not married yet, and I'm not being flippant. I think certainly before you kind of commit to each other legally and tie your financial futures together in a very legal way, you need to have a very hard conversation about money where you're both honest, because money troubles, especially when one person, for example, is really diligent and sensible with money and the other one isn't, or one's got a debt problem and the other one doesn't. Money troubles like that are one of the really biggest, I think it's top 2 biggest causes of divorce. So this is a serious thing, Angie, when you're getting married to someone that you hope to stay married to for the rest of your life. Then you have the conversation now, and you're talking about what's our approach to debt. These are my assets, these are my debts, this is my income. Please show me yours. And it's important because you when you get married, you are taking on some portion of responsibilities for the other person's financial position as well. And certainly knowing before the time that the person you're getting married to is very good with money or very bad with money allows you to protect yourself legally. And one of the things then will be make sure that you're sitting down with a lawyer to say, I'm really good with money, my partner's not, and we're getting married. How do I protect myself against them, financially misbehaving, for example? And there are ways that you do that.
It feels like the least romantic conversation to be had at a time where you're supposed to be coddled in candy floss and feeling heart flutters and joy. But it is the kindest thing you can do to this person with whom you want to spend possibly the rest of your lives, hopefully the rest of your lives. And it's the kindest conversation you can have, as difficult and as uncomfortable as it might seem to be. And you kind of would hope that by the time you get to the proposal stage, you have a decent sense of their values and what they value and the way they behave. Because a conversation about money, I'm not sure is enough, Warren, in terms of how do you feel about money? Well, I love money. Me too. I love treats. Me too. I'd love to invest one day. Oh, me too. That's not an agreement about money. That's not. We share a fairly common set of principles there. But it doesn't tell us about our habits. It doesn't tell us about our predilections. It doesn't tell us where we come from. So much of what informs our thinking around money is stuff that, the way we were brought up, where we grew up, how we grew up, financial stress in our families when we were little, whatever it might be. Those things you've got to understand blim and well long before proposal stage comes along, is my view on that one, Warren.
Agreed, and I think maybe also just to understand that if one of the two people in the relationship isn't good with money, and potentially sitting with a credit card bill that they're not really able to deal with properly, or too much other debt. It's important to understand that they might have a really deep sense of shame around this. I think we can't underestimate the psychological impact of this. So it's not just that people are sitting there just recklessly spending and being completely undisciplined and kind of reckless with their partner's money. They might have had to deal with some big debt issue for a family reason or whatever it is, but now they sit with this, and it's something they haven't brought up simply because they've got a deep sense of shame. And it's an incredibly tough conversation for that person to kind of just volunteer the information. So, if you're in Angie's position, it's understanding that when you have this, let's now put our bank statements on the table conversation. And that's really what you do have to do. Just be really kind of sensitive to the fact that the person on the other side of the table might be really keen to solve a problem and really ashamed of where they are, and not looking for some sort of big judgment where you go, oh my goodness, what on earth have you done? What's wrong with you? You kind of need to sit down and say, let's talk it through. How did we get here? How did you get here? And what is our strategy? Because it is now an hour. What is our strategy going to be to solve this problem? And I think you can build a really strong relationship on a difficult conversation, and you can break a really strong relationship without having the difficult conversation. So it's definitely worth doing now, but do it with a lot of sensitivity and a lot of understanding that it's really kind of, this is embarrassing. This is tough stuff to talk about, and a lot of families never talk about money. So it will be very hard for a lot of people to have this conversation. So do it gently, but don't avoid it. You have to do this. You have to kind of share everything. You're going to share your lives. You need to understand the money position. You don't have to share the money. You don't have to share your savings forever and all of that stuff. But you have to be clear now about your financial positions and how you're going into this.
You do need to know what you're getting yourself into. That it can go horribly awry, Angie. Horribly, horribly awry when you make an unpleasant discovery 6 months in, a year in, 5 years in. Or worse, when there are kids in the picture as well, and suddenly you realized, oh my goodness gracious me, I actually don't know this person that I've been married to for all this time at all. Terrifying, but necessary. Warren Ingram, founder and director at Galileo Capital, a personal financial advisor, and Thursday night contributor, of course, to The Money Show.